On what basis does a country print currency? Printing money is one of the most powerful tools a country has, but it's also one of the most dangerous if misused. Contrary to popular belief, a nation cannot simply print as much money as it wants to solve its financial problems. Every currency note represents a certain level of economic strength, productivity, and trust. Let's explore the key foundations that determine how and when a country prints money. 1. The strength of the economy, GDP. The foremost factor behind printing money is the country's economic capacity. A strong economy, with high GDP and productivity, can support a larger amount of money in circulation. When people are employed, industries are producing goods, and services are actively being traded. More currency can flow through the system without causing inflation. On the other hand, if an economy is weak and the government still prints money, it leads to a dangerous rise in prices and loss of purchasing power. 2. Foreign exchange and gold reserves. Every nation maintains foreign reserves, such as US dollars, gold, or other stable assets, to back its currency. These reserves give confidence to the market and international investors that the currency is reliable. If a country prints more money than it can support with reserves, its currency begins to lose value against others in global trade. 3. Role of the central bank. The decision to print money does not rest with politicians. It lies with the central bank, such as the State Bank of Pakistan. Before issuing new currency, the central bank evaluates the inflation rate, the interest rate, the amount of liquidity already circulating in the market. If inflation is already high, printing more money worsens the problem, as too much cash chases too few goods. 4. The risk of inflation and hyperinflation. Printing money without economic backing leads to inflation, or in extreme cases, hyperinflation. This occurs when the currency's value drops so drastically that prices of basic goods skyrocket overnight. Historical examples include Zimbabwe and Venezuela, where excessive money printing turned their currencies practically worthless. The lesson is simple. Printing money doesn't create wealth. It only reduces the value of existing money. 5. Real assets and national production. The real value of a currency is linked to what a country actually produces and owns. Natural resources such as gold, oil, minerals, agriculture, and manufacturing industries strengthen a currency's foundation. If a country relies only on printing notes without boosting its real production, the currency becomes just paper, with no real worth behind it. Conclusion. In summary, a country prints currency based on 1. Its economic strength, GDP and productivity. 2. Foreign exchange and gold reserves. 3. Central banks' monetary policies. 4. Inflation levels. 5. Real assets and production power. A stable economy depends not on how much money is printed, but on how wisely it is managed. True prosperity comes from production, exports, innovation, and fiscal discipline, not from creating paper wealth.